Okay, so it's that time. It's that time. We're going to get down to it. I'm normally giving you these process videos, but there's so much going on in the real estate world right now that I think it's important to, just kind of explain exactly what's going on, because the reality of it is a lot of people that I speak with that are new to real estate investing or are wanting to get into real estate investing, but they're scared of it right now. They're hearing all this gloom and doom craziness that's coming from, all kind of people, right? In the news media, quote unquote financial experts, and like Robert Kiyosaki, for instance, will sit here and say it's all gloom and doom. It's all going down. The biggest crash of all time. It's about to happen.
Something is coming. And I think this is going to be the biggest crash in world history.
And people are just uncertain. They're watching interest rates go up. They're watching home prices, home values go up. You're watching the news and they're saying, hey, they're going to come crashing down. They're going to come crashing down. And I keep saying, if you've listened to me at all, we're going to have a correction. We have to have corrections. That's what happens in all markets. It doesn't mean gloom and doom. It means shifting. You're shifting your perspective. Instead of making money going up, you're going to make money coming down. You're going to set yourself up for the future. That's all I'm ever talking about. Well, we have a Moody's a guy here. The Moody's analytics just came out with 183 markets that are going to show some decline over the course of the next year. That's what this looks like right here. I'll obviously share this with you and we'll talk a little bit more about it. But, they say that, and they are a lot of people, that we're going to have a crash. And that's not what the information shows. That's not what the market is dictating. That it's nowhere near any of that. So I want to get, right into exactly what this thing is going to be looking like, because, people are just, people make a lot of money, when they can create the crazy rhetoric, right? People make a lot of money when for ratings when it goes down like that. And that's all this stuff is. So I want to get into exactly
the extremely hot housing market appears to be cooling off. New details from Moody's Analytics says 183 different markets could see prices drop by up to 20%. On average, it estimates prices will decrease up to 5% nationwide over the next year. So for more on this, I want to bring in Mark.
So that's, 5%, nationally, and they're going to get into it. I have been saying 10 to 15% declines, on average. The worst case scenario, people are saying 20, 25, 30, 40% even. And you know what? Are we going to have some pockets that may do that? Sure. But on average, that's not going to happen. So let's jump right back into it here.
Mark Zandi, he is a chief economist for Moody's Analytics. Back in May, you predicted that home prices would drop as part of a so-called housing correction. So let's talk about it right now. The price of houses typically do start to go down at the end of August and sort of keep going down. The high is always in the springtime. Right. But you're talking about something that's more than just a cyclical drop in price. You're talking about a correction. What is a correction and what caused us to need a correction now?
So before he gets into it, I just want to be clear. She mentioned cyclical corrections, meaning, when demand for houses goes down, generally around the holidays, like Thanksgiving and beyond, prices tend to fall naturally because there are fewer people looking to move during the holidays. Whereas, the springtime comes, or January, February, March in particular, people are planning their move for the spring. And they want to move within the summer months or before the summer even, so they can go on vacation, do things with family, and so on and so forth. So those are cyclical things. Corrections are very different. And let's listen to the man here from Moody's explain that to us.
Yeah, you're right. You're talking about seasonal house price movements, and this is not that. This is declines in housing values in different parts of the country. Nationwide, peak to trough, when it's all said and done, probably about 5%. Obviously, that means other parts of the country will experience price declines that are in the double digits. Mm-hmm. Behind this is the fact that mortgage rates have risen very significantly in a very short period of time. So if you go back, let's say about a year ago, Anne Marie, mortgage rates were below 3%. That's a 30-year fixed rate loan, pretty close to a record low.
Right.
And now it's double that. So mortgage rates have doubled.
Yeah. So again, another factor for the slowing down of home purchases, outside of everything they're talking about with supply chain issues, and a lack of inventory and so on and so forth, interest rates are going up. So for the past 10 years, 12 years even, interest rates have been at the lowest they've ever been historically. And a lot of people who were maybe not thinking about buying a house, maybe they were, when the financial crisis came and real estate was going through what it went through, and the financial markets in general were going through what they went through, interest rates were like below zero. You can get, well, not below zero here, but they were zero, and you could get really, really cheap money and you could buy a lot of house. So, and let's say 2009, 2010, someone that was 18, 19, 20, 21 years old, maybe just getting ready to graduate from college, probably wasn't thinking about buying a house. And so when they started to look at that, once they got out of college and got their career and started to think about it, 4, 5, 6 years later, when interest rates were still really, really low, they were used to rates being that low. That's normal to them. So now that interest rates are 5 and 6% again, and that's, affordable money based on where we are in the cycle of the economy right now, they think that's high, and that makes them pull back out of the market and go towards a rental situation, which is a whole nother conversation. So let's get
a year. And when rates were low, demand was strong, prices went skyward. Now with higher mortgage rates combining with those now higher house prices, homes are no longer affordable. I'll give you one quick statistic. For the typical homeowner buying the typical home with a 20% down payment, at the current mortgage rate, they'll be paying $500-$600 more a month on that mortgage than they would have a year ago.
Right.
So for many first-time home buyers, that's just unaffordable. So demand is drying up, and therefore prices have to adjust and come back in. It's just
and it also makes them go buy less house. What is less house? Okay, if you're a first-time home buyer, you're looking at maybe a 2,200 square foot house. Maybe you're stepping that down price-wise, and you're going into, because you still want to be in a good neighborhood, right? A good area. Maybe you're going down to a 16 or 1,700 square foot house. And, that smaller size would generally equate to a lower price depending on where you are. So you have to look at that, but just to keep it simple, if you're looking at a $350,000 purchase and it's outside of your financial spectrum right now because of interest rates, it pushed the payment up. Now you may have to step down to 275, 280, possibly 300, but you're going to have to step down price-wise, which generally means a lower house, a different neighborhood, something in that matter. And as he said, for first-time home buyers, it just pushes them out of the market because they want what they want. And a lot of first-time home buyers are really used to renting right now. And even though rent is going up, it's like, okay, is it cheaper for me to rent or is it cheaper for me to buy? Let's weigh those options. And with rates as high as they are, it could be 6 in one, half dozen in the other, right? Maybe there's no difference in price. So why put yourself through it when you can wait a little while and get the best bang for your buck? And I think that's where people are going, right?
Reflection of the movement in mortgage rates.
That makes sense. But I thought this country was dealing with sort of like a decades-long shortage in housing stock. And so I thought, well, maybe that would be another factor that would keep house prices up. But you say no.
Well, that'll help. I mean, I think that's why this is a correction. We're down 5-10%, peak to trough, not a crash. If you go back in the wake of the housing bubble and the financial crisis a little over a decade ago, prices fell almost 30%. And so this is a correction. It's coming off of very high house prices, but it's not the kind of broad-based crash in house prices we saw, a little over a decade ago. So you're right. That shortage of homes, and it's an issue. It's a problem. It's one reason why prices went skyward when mortgage rates fell a year ago. Will help support the housing market. It just won't save it from this correction.
So what I find very interesting, though, is that different markets vary widely. Can you
Right.
talk about why you think there's going to be a more drastic correction in some markets than others, and what give us?
Okay, so this is going to be the really interesting part of this conversation, y'all. So more often than not, I mean, if you're new to real estate investing, and that's why I want you to see this, so you understand that there's always opportunity. You just have to see what that opportunity is. You have to look a little bit differently sometimes. You'll hear me talk. The market dictates what method I'm going to be using at any given time, right? I may not be able to fix and flip the way I wanted to. I may not be able to wholesale the way I wanted to. So I've got to find very unique ways to get into the real estate world, into ownership, into control of the real estate, so that I can prepare myself for the upswing when it's coming. I'll still make money today because I'm thinking about cash flow more than I'm thinking about equity, because equity isn't really, really right there right now. But we're going to talk about that here in a second. I just want to get down to it. So check this out.
Give us a few of the cities that are going to see it the most.
Yeah, exactly. The most previously juiced up markets when mortgage rates were really low in the Southeast and Texas
Yep.
and the Mountain West. That's where prices went skyward, and that's where affordability is now a problem with these higher mortgage rates. And that's where we're going to see the most significant price declines, going forward. So examples, Charlotte, North Carolina, Atlanta, Tampa, Austin, Texas, Boise, Idaho, Phoenix, Vegas. Those would be the areas where valuations are out of whack.
All right, so he talks about valuations being out of whack in those areas, and we know for sure that they are. It's not the city in its entirety, it's the pockets inside those cities. Some of those areas are going to maintain their value. Some parts of them are going to continue to increase, while other areas where maybe the envelope was being pushed, those are the areas where we'll see bigger corrections. I'm in Atlanta. I know those areas that are turning over, that haven't fully turned over yet, where big institutional investors came in and bought up everything at retail prices. They pushed out the little guy and they paid retail prices for everything. And they're leasing those properties out. I won't go into the story about the Zillows and the so on and so forth, but they made some mistakes by purchasing like that, which helped those values get pushed up, but they're up there now, right? And those areas are going to correct. And it's inside of those areas that you're going to find your opportunities. It's inside of those depreciating values that you're going to get your subject to deals. It's inside of those values, those declining values, I should say, where there were people that had, small houses or houses that were just beat up, that were trying to get this institutional money, and now they can't, because the institutions have shifted the way they want to buy, because they won't have to buy properties that need a bunch of work. So it's an opportunity for you to come in, but you really got to look at the numbers, because it isn't as simple to just do a fix and flip right now because of these increasing values. They have to come down, and you have to play another game. We're doing subject twos, and we're taking properties with as little as 5% equity currently, because we're looking into the future, 3, 4, 5 years down the line with those properties. Okay, so let's let him talk again.
Affordability is a real problem now. Demand is falling. We'll see some prices come in. The other thing that's going on in some of those markets, previously you saw so-called flippers come into the market. These are folks that would buy with the intent of selling very quickly to make a quick buck. And that works when house prices are going up quickly, but that's not working now. So they're going to get out of the market. They're going to be wrung out of the market, and that'll cause more price weakness in places, again, like Phoenix and Atlanta.
All right. So if you're looking for a house and you want to relocate.
And that's exactly what it is, right? I mean, those people that are going to, some people are going to get caught with their hand in the cookie jar. I mean, it just is what it is. It's not necessarily right or wrong. I know it's uncomfortable when it happens to you, but that's what happens when you push against the wall, right? You're pushing against time. Eventually, you hit these plateaus. I've been here 3 or 4 times now, but you hit these plateaus and you see what's coming. Do we still have a couple fix and flips out there? Absolutely. But the vast majority of the fix and flips that we have, we got the properties. Even if we have to sell them for less than we intended on selling them, we've got the room. We built the room in, okay? The properties that we're taking over owner financing, subject to, creative financing methods. Those are properties that we're planning something for later on down the line. Okay. We're doing short-term rentals, and there's a number of ways that those can go. We're in the multifamily and those kinds of things. We're focusing on those kinds of situations because there's still going to be a lot of people that need to sell their homes that haven't quite sold their homes, but they owe so much on them and they may not be able to. I shared stories about this with you guys. There's opportunity there. This is not gloom and doom, right? Going back to this map, which I'm going to share this article and this video as well as this article and this map, and it's going to detail, these areas, what their expectations are and what is to come for these 183 markets, right? Or what's expected. Now, it doesn't mean that's exactly what's going to happen, good or bad, right? But it does mean that there's going to be a correction, and that correction is going to occur, over the next probably year and a half, right? You're going to feel it. You're going to feel it. And as we get closer to the 2024 election, then things at some point after that will start to ease up a little bit. But we'll have to see this correction. The corrections will generally last, a correction, not a typical market correction, but a correction like we're about to go through will typically last 12 to 18 months. So it's halfway in there, 6 to 9 months in there, that you'll be at the bottom, and you'll be able to recognize that you're at the bottom because things will start trending upwards. If you're in position before that, like I'm telling you, to find a way to be, if you're in position before that, when it does turn around 2-3 years from now, well, it won't take that long, but once you start selling things as they go up past where you bought them, so 2-3 years from now, when you start selling those things, now, if you're getting, our goal is to get, 20 or 30 of those a year over the course of the next couple of years. And if all we profited was 30,000, 25 to 30,000 on each one of those, we'll have 40 to 60, let's say 50 houses that will show a profit of 25, 30, maybe even 40,000, but an average number, just say 30,000 3 years from now when we sell them. That's a lot of money. All right. That's a lot of money that we're planning for. We're planning for that tomorrow's profit today, not to mention the write-offs that we're going to get. So I just wanted to share some of this information with you so that you can understand that it's not all gloom and doom. There's no reason to be scared to enter into real estate investing. If you've wanted to and you haven't, jump out there and learn, because it's a lot easier to find success later when you learn how to do it in troubled times, in troubled times. And this isn't even really that bad compared to what happened in 2007, 8, and 9. I mean, people were decimated, okay? And there will be some discomfort here, but you will have an opportunity to help people, not just yourself. You will have an opportunity where people won't be able to sell their houses because they don't have enough equity in it so that they can pay the taxes, that they can pay the real estate agents. They just won't have it. And as it turns back into a buyer's market, and as opposed to a seller's market, which is what we're going to be seeing, there's going to be more seller contributions to closing. So you're going to have to build these things into, your ask. But you're looking for the troubled situations, the people that don't have enough equity, the people that need to sell it now that couldn't sell it because there were all these forbearances that had been done and they just couldn't do it. Now is the time for you to get involved. Now is the time for you to take action. Now is the time for you to learn and implement. Now, because when it does get good, you're going to know exactly what to do based on your needs, your desires. And if you want more information like that, please just, click the description below. We've got some free stuff in there for you. So you could start learning how to invest in real estate. Set up an appointment. Let's have a conversation. Let's have a conversation. Everybody wants to invest differently. So let's talk about that. My name is Myles. Make sure you hit this like button and subscribe button. Hit the little bell so you can be notified when we're releasing information, because I'm doing it a couple times a week. And don't forget the Real Estate 360 podcast. This is your man Myles for Real Estate 360. I'm out, and I hope this was helpful. Peace.